Welcome to this video. Today we're going to talk about SMCI, Supermicro, the most undervalued AI company. In this video we're going to go over the latest news, fundamentals and technicals, and we're going to find out whether today is a great buying opportunity for the long-term investor. So buckle up and let's dive right in. We're now looking at the charts on TradingView of SMCI, and we can see it's now trading at $32.64. And we can see that last Friday it went up over 10% in just one day, which is a very bullish signal. But it seems to find a little bit of resistance here at the 50 simple moving average. We can see that my average cost price is around $39, so I'm roughly down 16%, but I'm very bullish on this company for the long term. If we look here on weekly candles, we can see that it dropped below the 200 simple moving average, but it happened here before. So this could potentially be bottom, and last week a massive green candle. So I think that the probability is that we will see higher highs in the near future as well. Supermicro SMCI is an AI infrastructure company, and they're making servers for data centers or for other companies that are using these supercomputers to run their AI models. It's essentially a hardware company that buys like chips, for example, from Intel and Nvidia, and they use that to build like this supercomputer, and they sell to customers who need that for their AI learning models. And they make these computers very efficient. SMCI is usually like a hardware company. They make these computers by putting all these chips together and building like a supercomputer. Now they're also collaborating with other companies to combine the hardware with the software. So these other companies, they will do the software and they're going to use it for stores. So here we can read, Supermicro announces intelligent in-store retail solutions in collaboration with a broad range of industry partners. So they're going to implement AI in physical stores to make them more safe, more sufficient, and that will make these stores more profitable as well. So what does it mean? It means AI-powered intelligent in-store retail solutions designed to meet increasing customer expectations with scalability, improved productivity, and increased profitability. Here we can also read, AI is reshaping shopping experiences, enabling real-time analysis of video and other data to give retailers actionable insights to optimizing staff efficiency, reducing shrinkage, increasing profits, and avoiding stockouts. So they're going to do this collab with these partners to use their computers with their software, and they combine it, and this could be a new way of making money for SMCI, which could potentially be very beneficial for the company in the long term. Supermicro is collaborating with ecosystem partners including Everseen, Kinetic Vision, Allsides, LiveX, Wobble AI, and Able to create intelligent stores that positively impact day-to-day retail operations as well as longer-term supply chain management. So they're going to use the AI to make stores more efficient, and this could be a second business model for SMCI, which is great for the company and also for the stock in the long term. We're now looking here on Guru Focus to get a quick financial overview of the company. We can see that they gave it an 84 out of 100 score, which is pretty high. And what I find very interesting of this company, that is an AI company that has a market cap of only $19.49 billion, which we can see here. And that is very low for a super high-tech AI company. And this AI infrastructure company is very, very cheap as well. So the majority of the AI companies with a small market cap of only $19 billion are not profitable. They're losing money, they're burning cash, and they increase the revenue, but in the hope that in the future they can make money. But SMCI is already making money, and that makes it like super undervalued. So we can see that the financial strength is a 7 out of 10. The profitability rank is an 8 out of 10, which means that they make money. They have a positive net income. If we can see here, the financials in the graphs, we can see it's also it just went exponential after 2022, the revenue. And the net income isn't the highest, but it's still positive. And the cash to debt levels are completely in check, where the cash is even more than the debt, which shows that they have a very stable company. And the majority of the AI companies on this market cap size level have a lot of debt. So this is pretty interesting. And I think that's also very undervalued, but we'll come to that later. The first metric investors look at to know whether a company is cheap or expensive is the PE ratio. So what is the PE ratio? It's the price to earnings ratio. And what does it mean? it tells you how expensive a stock is compared to its profit. So price divided by earnings. So the stock price divided by its earnings per share. So this is the formula. PE is share price divided by earnings per share. So for example, let's say a stock price is priced at $50 and the company earns $5 per share per year. Then what's the PE ratio? Think about it, right? Is the P divided by E, so stock price divided by earnings. So 50 divided by 5 is 10. So the PE ratio is 10. So the lower the PE ratio, the cheaper it is, because let's say it makes $10 per share, so it makes even more money, but the stock price is still 50, then 50 divided by 10 is 5. So then the PE ratio is only 5. So the lower the PE ratio, the cheaper the company is, and the higher the PE ratio, the more expensive. Now we know what the PE ratio is, so let's look what the PE ratio of SMCI is. So Supermicro Computer PE ratio 2012-2025. But here we can read like the Supermicro Computer PE ratio as of January 16th, 2026 is 25.70. So if we look here at the charts, we can see that this is the stock price, and we can see that in the last 5 years that the price is around 30 and the P ratio is 25.7. So a P ratio of 25.7 is pretty average, especially for a high growth company. I wouldn't say it's cheap, but it's also not expensive. And it's slightly above the average. But just based on PE ratio, it's pretty fair value, I would say. In order to do a more accurate valuation, whether the company is cheap or expensive, we're going to use owner earnings from Warren Buffett to find the true value per share. So what are the owner earnings? The owner earnings is a valuation method detailed by Warren Buffett in Berkshire Hathaway's annual report in 1986. He stated that the value of a company is simply the total of the net cash flows, owner earnings, expected to occur over the life of the business minus any reinvestments of earnings. So the owner earnings is essentially what's left for the stockholders. And all the future earnings, you're discounted to present value because money today is more valuable than money tomorrow. So all the future cash flow, you need to discount to present value. Then we can get a more accurate valuation of the company's true value. So I made a calculator to find the true value per share by using Warren Buffett's owner earnings. And the formula for owner earnings is essentially net income plus depreciation and amortization plus other non-cash items minus capital expenditure. And that is basically the owner earnings, which is basically the profits that's left for the stockholders. And we're going to discount that to the present value. And we are going to deduct the net debt, but it's positive, so that will increase the value. You can see the current market cap at 19 billion, and we are going to use a 70% earnings per share growth rate for the next 5 years, and after that we're going to halve it. So 70% is pretty conservative. So let's find out what the true value per share is. So based on this calculator, we can see that's undervalued by 43%, and that the true value per share is around $58 with a relative conservative measurements. So I think that buying right now based on this valuation gives investors a margin of safety, which is great for the long-term investor. If we're going to double check the intrinsic value, we can look at alpha spread, because they also do a discounted cash flow model, and they come to the conclusion that it's even more undervalued and that the true value per share is $77 on a base case scenario. And here we can see like the dotted line is the intrinsic value, and we can see the stock price. And we can see that the discrepancy between the intrinsic value and the price is pretty significant. So based on this website, it's also really undervalued, which could be a very interesting opportunity for long-term investors, because this doesn't happen all that often. So we know this company is undervalued. It's in a booming market. It's in the AI infrastructure market, and it has a lot of potential upside. But does it have a strong economic moat? So the economic moat is a competitive edge that protects the company from competitors. And this is a theory popularized by Warren Buffett. So we can find the economic moat here, and we can see that SMCI has a narrow moat, and the overall moat score is 6 out of 10. So they do have my moat, but not the strongest yet. So Supermicro has hardware design expertise and growing demand in AI infrastructure, but lacks strong brand power or locking effects and faces many competitors in the server and component market. So here we can see the strength and risks: strong position in AI server market, agile and quick to market with new technologies, customization capabilities for enterprise clients, risks intense competition from large players like Dell, HP, and Lenovo, commoditization of server hardware, reliance on component suppliers, exposure to volatile semiconductor cycles. So we're back on the charts again on TradingView, and we can see this massive green candle from last week, and I'm very bullish on this company. I have a full position right now, and my average cost price is at $39, and I think that's a pretty good average cost price. I will hold this stock for at least a few years, and I think it will be much and much higher. If we go back on daily candles, we can see there's a little bit of resistance of the 50 simple moving averages. So maybe we can see a little bit more volatile, but I think that this company is going to go bounce, because I think we are now in a sort of consolidation. The earnings are coming soon. I'm very interested in that as well. There are of course some risks involved with this company. The economic moat isn't the strongest, and they do have competitors. But I believe that buying right now will give investors a margin of safety, and I think the upside is still tremendous. Of course, always do your own research, your own due diligence. This video is just for educational purpose only. But if you want to see more of this kind of content, feel free to like and subscribe. And if you even want to support me more, consider becoming a member by clicking the button below. And you will get also access to a few exclusive videos as well. With that being said, I hope you have a great day, and I'll see you in the next video.